Markets are going to be paying attention to Fed Chair Janet Yellen's two-day testimony on the Hill, which will begin later this morning. Will Yellen's appearance help or hurt the market rally, or not have any effect? Joining us now is Michael Tyler, Chief Investment Officer at Eastern Bank Wealth Management in Boston, and Jim Swanson, Chief Investment Strategist at MFS Investment Management. Jim, good or bad for the markets, or doesn't matter?
It's not going to matter. She's not going to change her stance here. She's still concerned about the jobs market. She may have this wrong, but I think she's going to keep very steady here with her taper plans. You're not going to see any new news.
Mike, is the law of diminishing effects from this QE is well known to most people, I think. Is it worth it to keep going, even though we don't know the long-term effects and the benefits seem to be shrinking?
I think it's pretty clear that that getting out of the QE business is the right thing to be doing. The question is whether that's enough or whether she needs to start thinking about tightening a little sooner than currently she's been expecting. In other words, is the labor market beginning to tighten up a little faster than the unemployment rate, which has by itself been coming down quite quickly?
So that's the question to both of you gentlemen is, are you behind the curve or just right? Is it like the three bears? The monetary policy at this point, just right, Mike, or behind the curve?
I think they're beginning to slip a little bit behind. I think that the unemployment rate is coming down quickly, even the long-term unemployment rate. I think that inflation data is beginning to pick up a little bit. Companies are reporting that there are some spot shortages of skilled labor. So we are seeing signs that the economy is gaining a lot of momentum, and they should start thinking a little more quickly about what to do next.
We got Macaulay coming on. He's going to say that Janet Yellen is just doing a phenomenal job. And to me, this sort of going 10 each month, getting out of Bernanke's thing, can we grade her? Do we have any idea if she's any good at this point? Do you know?
I think it's still early to say. But what I do notice is that she is talking and doing slightly different things.
Like what?
She's got the cover of Europe. Well, for example,
she did get the cover of Europe.
That does allow her some flexibility to be a little bit tighter, because European investors will keep pushing Treasury rates here downward simply because it's so much lower in Europe. So she has that opportunity. And if you look at their estimates for things like what the Fed funds rate will be in 2.5 years or 1.5 years, and compare that with where the markets are, she is actually somewhat more hawkish in her action and in the Fed's estimates than the markets are currently expecting. But her words are still emphasizing the uncertainty and still emphasizing that it is a fragile economy. So she's kind of playing it both ways a little bit, and it will be very interesting to see, as Becky said at the top, it's showtime. It's time for corporate America to start delivering the earnings that will demonstrate that, in fact, the macro data, that the economy really is on a stronger path.
Okay, so both of you think the market is what? Fair valued, overvalued, undervalued?
I think the stock market right now the stock market is slightly expensive, but compared to the fact that interest rates are still near historic lows, I'd say it's reasonably attractive and certainly by no means overvalued or fully valued. I think you need to look for sales growth as well.
Yeah, but that's going to be pretty good too. They're looking for 4%, right? Which is much better than the last couple of quarters, right?
Exactly. You need to see sales growth and double-digit earnings growth to support the market at this point, and I think you'll get it.
Okay. Thank you, gentlemen.